Stock market crash protection strategies. This is one of the better articles I've seen on this, actually. A lot of stock market crash just tell you, just be wary of a stock market crash, but they don't really tell you what to do. This one does. It's pretty interesting. So let's dive into this. My man, what's the guy's name here? It's John Lawrence at John Lawrence or JALawrence.net. Links in the show notes, and he just wrote this the other day. All right, so let's go with this. There's tons of he did this good article, man. Good article. I'm there he is, my man John Lawrence. All right, cool. He's founder of J.A. Lawrence Wealth Management and investment advisor. All right, so let's only got 10 views. All right, so he just started this blog. So let's see what we got for him. I like this. So anyway, there seems to be questions circulating whether or not the stock market is going to crash. The answer unequivocally is yes. Since the beginning of markets, we've always had crashes. The question investors ought to be asking themselves is not if the market will crash, but how they're prepared for it. Market crashes are not black swan events. Over the past 20 years, we have seen 3 massive market downturns. The plain and simple truth is the market crashes need to be built in with your investment plan. The largest concern of an investor, especially a retiree, should not be how significant a market decline will be, but rather how long it will take to reach its previous high. I actually agree with that 100%. This is the most important aspect for a retiree to understand. In investing, there are 2 questions to answer. 1, what will happen? And 2, when will it happen? The what is most certainly the easier of the 2, because we know a market will crash. The when is more difficult part to get correct. And ultimately, investors need to make sure they are incorrect in trying to make sure. Ultimately, investors need to make sure that when they are incorrect in trying to answer these questions, it does not destroy their portfolio. A retiree needs to understand there are 2 main options in a market crash. Have the cash position to outlast the bear market, have already diversified themselves away from the bear market. In my opinion, both defensive options need to be attempted. Oh boy, here come my friends. Hello, everybody. And if an investor takes a long-term view at the Dow Jones, everyone will notice that markets have always recouped the losses that have occurred in the downturn. Yeah, he's all right. All right, thanks, girl. Got visitors. If we know the markets will almost always recover, let's explore the when. So that's right. So I could not agree more. I mean, assuming that the markets recover, and if you're investing in the market, you have to make that assumption. I mean, just do. It's one of those things all the time. You say, look, I mean, we could go to Bolshevik Revolution where they take all of our assets, our wealth, or Klaus Schwab, something like that, Schwartz, something like that from the World Economic Forum, we'll own nothing and be happy for it. There's nothing you can do about it then anyway. So assuming that does not happen, you have to assume the markets will recover. The question is when and how do you deal with that? That's exactly what my John is asking. All right, so here we got the bear market of March 2020. The bear market was a fast, severe downturn with a remarkably quick recovery. The time to recover, 10 months. Avoidable via diversification, no. So even if you were diversified, you still got smoked in that bear market. That's so being diversified there did not keep you safe from a bear market, if that makes sense. So in that case, because you couldn't avoid it by diversification, you want to make sure you have enough cash on the table to make sure that when you needed to pull money out, you didn't have to take to have a declining market. The housing bubble, 2008 to 2013, this bear market was severe and felt around the world. The event ultimately changed central banks for years to come, and it challenged even the most conservative cash balances held for retirees. Time to recover, 5 years. Avoidable via diversification, no. It hit everything. Hit everything except government bonds, but I don't know if I agree with that. I get what he's saying. If you could have diversified the risk, that was a challenge right there, man, because it did take 5 years to recover. So diversification in your overall investment portfolio, everything got smoked except for government bonds. And then if you had enough cash on the side, you'd have had to have a lot of cash on the side. So I agree. Avoidable via diversification, no. I mean, I don't disagree with what he's saying. You could not have avoided it with diversification. That's a fact. And even the most conservative cash balances got challenged. I agree with that. The above-mentioned market crashes are recent crashes that had one main defense, high cash savings rate. Yeah, exactly. So diversification alone would not suffice to protect investment balances worldwide. Let's explore more secular market crashes where diversification would have offered protection. So what he's saying here, I actually agree with this. He's saying your cash would have avoidable via diversification in this last year, no. But if you had cash on the side, it was a big fat nothing burger. The housing bubble avoidable via diversification, no, because everything got smoked. If you had cash on the side, you probably would have been okay. Most investors feel diversified owning one large index. For an example, the S&P 500. Most may consider owning this index a diversified portfolio when in fact all it has done is set up a concentrated portfolio relying on one country's performance. There are many instances in history where the secular investment approach has crushed portfolios for an extended period of times. And it can leave portfolios vulnerable to never having enough cash to survive. Exactly. It gives the NASDAQ.com bubble. 2000 was down 80%. Time to recover, 14 years. Avoidable via diversification? Yeah, absolutely. So you could have diversified yourself, not just had everything in NASDAQ, and you would have avoided getting smoked like what happened in 2000 by just NASDAQ. Now, the NASDAQ stuff got smoked. If you would avoid large cap growth stocks exclusively, yes, the large cap growth stocks you held in your portfolio got smoked, but you would have recovered for sure. But if you had everything in large cap growth stocks, unbeknownst to you, because you're chasing, the gold, you were done for. Japan, Nikkei versus the S&P 500. Japanese investors were crushed by their extended bear market, 28 years. Avoidable via diversification? Yep, you could have avoided that via diversification by not having everything in the Nikkei. A lot of people invested in the Nikkei, though. Why? Because in 1990, the Nikkei was, hey, everybody, Nikkei. Here's those boys. Europe's FTSE, 100-year, 20-year-long bear market. All right, so a time to recover 17 years. So look at that. The FTSE, Europe's version of the S&P 500, found itself in a significant bear market starting in the 1990s. You could have avoided that with diversification too. Hey, I'm trying to do a video, buddy. Hey, I'm trying to do a video. Gotta rescue me from a screaming dog. Old Finnegan, what a nut. Can this type of long bear market happen in the United States? Well, it already has. The Great Depression occurred in 1929. The Dow did not reach those highs again until 1954. That's crazy, man. Could you avoid that via diversification? Not likely, because the S&P 500, the Dow, pretty much, you didn't really have small caps back then. So let's focus on a specific time period from the very first chart we've seen at the top. From the time period, we can show the Dow. S&P was not created until the 1950s. Hey, thanks. Oh. What is an investor retiree to do in a market more reliant on stocks than ever? Step one, retirees need to thoroughly understand the two-bucket retirement approach. Yep, could not agree more. This approach will help navigate market downturns that can be resolved with cash reserve discipline. Non-retirees need to stay invested and not lock in those losses. This is much easier feat when people have a high cash reserve. Yep, I completely agree with that. Step two, intelligent Social Security planning. For circumstances illustrated in Nikkei and the FTSE, the wait as long as you can approach for retirees would be the most beneficial. Make sure you have enough income from other sources that you don't have to pull from a market decline. Steps three, consider investing in a world stock index. There are indexes that own almost 8,000 stocks throughout the world. This approach may be the only one that allows investors to own both stocks and avoid vulnerabilities to any one country's particular problem. Right on, man. I actually agree with that. I was sharing the other day, someone had mentioned the Global Wellington and Global Wellesley Fund. That looks pretty good. They've only been around for a few years, so not enough of experience to know that much about them, but this seems pretty attractive to me. Global Wellington and Global Wellesley. Let's hold on. Let's just take a look here, shall we? Let's bear with me just a second. All right, here's a Global Wellington fund. Let's just look here. And again, it hasn't only been around since 2017. Let's go to performance, and let's see what we got here. So we have, I guess, 2018 is down 4. 2019 is up 22. 2020 is up 7. Yeah, we just don't have enough track record, man. That's a drawback. Worst 3, worst 1 year. Did we get worse? Yeah, last. Okay, so we don't really have much of a history, but I kind of digging where this is going. Stocks and bonds over the entirety of the. Let's go. I think we want to go. Yeah, right here. Let's go to 5 year. All right, so right there went from 23.63 to 17.51. So 23.63. That's $6 a share. Let me get my calculator. 6 divided by 23. Oops. 6 divided by 23. Yeah, my goodness. 6 divided by 23. So it fell 26%. So not nearly as bad as what happened in the S&P 500. I fell heavy though, and then it's recouped though. So we got some right there. 23.63 to 18.59. No, what was that? That's not 23. 2069 to, so we lost $2. That's 10% right there. You see some choppiness, but not, it's not horrific. Let's see what the holdings are on this guy. Stocks 65%, bonds and cash 35%. Let's see, market. Okay, does it tell us like what countries are? I don't see any country holdings. I'm not sure. So it invests 60 to 70% of its assets in dividend-paying, to a lesser extent, non-dividend-paying equity securities of large and mid-sized U.S. and foreign companies. So this would be a pretty conservative portfolio, man. Then they got the Vanguard Wellesley Global Wellesley Income Fund too. So anyway, something to think about. Links in the show notes, but good stuff. Good article there, John. So good job. Wish you the best with your writing. All right, we'll see you.